To measure the Trump administration from 2017 to 2021, we must strip away political rhetoric and look directly at the math. This requires a strictly empirical approach, relying entirely on primary data from nonpartisan federal agencies, like the Congressional Budget Office, the Bureau of Economic Analysis, and the Bureau of Labor Statistics. When evaluating Donald Trump's policy record, the timeline naturally splits into two distinct eras: the pre-pandemic years and the COVID-19 crisis. In the first 3 years, the macroeconomic indices showed significant strength. Job creation continued a long upward trajectory, and the stock market regularly set new highs. While market indices are often cited as the primary proof of success, the federal data suggests a divergence between these market highs and the country's underlying structural health. The central question of this analysis is whether the temporary surges in growth were offset by measurable regressions in the nation's fiscal, environmental, and social baselines. This line graph shows gross domestic product growth from 2017 through 2019. The economy expanded at an average annual rate of 2.5%. That is solid growth, but it sits slightly below the post-recession average and below the historical norm of 3.2%. During this pre-COVID period, the administration added 6.7 million jobs, a strong continuation, though fewer than the 11.6 million added during the prior recovery. Still, the tight labor market drove national unemployment down to a historic floor of 3.5% by 2019. Yet that tight labor market did not translate into proportional gains for workers. Real wage growth, adjusted for inflation, averaged just 0.3% annually, trailing slightly behind the previous recovery years. The primary legislative engine for this economic stimulation was the 2017 Tax Cuts and Jobs Act. According to the Congressional Budget Office, these reductions provided an immediate injection of capital into the economy, but they carried a steep price tag for the Treasury. This area chart tracks the national debt, expanding from $19.6 trillion in 2017 to $27.7 trillion by the end of 2020. Deficit spending surged well before the pandemic began. The administration effectively engineered a short-term economic boost by drawing directly against the country's long-term fiscal sustainability. Another major pillar of the administration's economic strategy was the implementation of protectionist trade policies, specifically targeting Chinese imports. The tariffs covered roughly $370 billion in Chinese goods, alongside widespread 25% levies on steel and 10% on aluminum. In highly targeted sectors, this strategy yielded results. Between 2017 and 2019, the economy added 133,000 new manufacturing jobs. However, macroeconomic data highlights a drawback. Multiple economic studies confirm that the tariffs cost U.S. consumers an estimated $10 to $15 billion annually through higher prices at the register. Furthermore, the action triggered immediate retaliatory countertariffs from international partners, inflicting damage on American agricultural exports. As this dynamic bar chart of Census Bureau data demonstrates, the U.S. trade deficit actually widened from $505 billion in 2016 to $616 billion in 2019, a 22% increase. By inviting global market retaliation, executive protectionism paradoxically worsened the exact trade imbalances it was designed to fix. Alongside trade, the administration pursued an expansive deregulation agenda, rolling back approximately 100 environmental rules through the EPA. By weakening the Clean Power Plan and relaxing restrictions on methane emissions, the policy aimed to reduce costs for the domestic fossil fuel industry. This shift required a retreat from international commitments, notably the withdrawal from the Paris Climate Agreement, which global carbon research shows reduced international momentum for climate action. But despite sweeping federal protections and reduced regulations, the actual labor outcome for the domestic coal industry remained negative. This diverging line graph tracks energy jobs. Even with federal support, coal employment drifted downward from 50,000 to 40,000 workers. Concurrently, a second line maps the renewable sector, surging organically from 614,000 to 807,000 jobs over the same period. Broader macroeconomic forces and a global transition in energy markets overrode federal regulatory intent. In healthcare, executive and legislative actions targeted the Affordable Care Act, most notably by reducing the individual mandate penalty to 0 and cutting enrollment advertising. This CMS data dashboard plots ACA marketplace enrollment, dropping from 12.2 million down to 10.1 million people. Consequently, the national uninsured rate increased. Similar structural economic impacts also appeared in the administration's immigration and border control policies. By restricting immigration and reducing refugee admissions to a historic low of 18,000, the administration restricted the labor pool. This contributed to worker shortages in agriculture and hospitality, raising domestic production costs. To see how all these disparate policies interact, economists look to the Gini coefficient, a metric used to measure structural income inequality across a population. As this dial shifts, it illustrates census data showing the top 1%'s share of national income expanding from 20.1% to 20.5%. These metrics point to a dual pressure on the household level: reduced access to social safety nets and a tightening concentration of wealth among the highest earners. Then, the COVID-19 pandemic arrived. Early assessments by the Government Accountability Office noted that inconsistent messaging and coordination delays hampered the initial federal response. By April 2020, the United States labor market experienced the most sudden and violent economic disruption since the Great Depression. National unemployment spiked vertically, peaking at 14.7% in a matter of weeks. While a recovery did begin by the end of 2020, it was sluggish. The long-term employment gap persisted, and it took until late 2021 to fully recover the jobs lost during the initial crash. An economy already heavily leveraged by pre-crisis deficit spending was uniquely vulnerable when forced to absorb a massive exogenous shock. Looking at the complete data set, the administration delivered successes in its first 3 years: historically low unemployment and a stock market hitting record highs. But a rigorous evaluation requires us to weigh those temporary highs against the structural costs required to achieve them. This matrix highlights the trade-offs. The debt-to-GDP ratio exploded long before emergency pandemic spending, and aggressive tariff policies widened the very trade deficit they were meant to shrink. Simultaneously, environmental regulations were dismantled, and healthcare accessibility dropped as millions exited the ACA marketplaces. The raw statistics map out a clear trajectory. Objective metrics demonstrate measurable regression across multiple foundational indicators of national health. Economic policy cannot be judged solely by peaks of surface-level boom cycles. It must be measured by the long-term structural resilience it leaves behind.